Good afternoon, everybody, and welcome to this very special Absa Insights series. Today, it's all about consumer goods and a sector which is extreme pressure during lockdowns through COVID-19. If you look at today's unemployment numbers, you would think that this was a sector that was about to start booming, with unemployment at 23.2% in the second quarter. And I laugh simply because it's an absolute fiction. There has been a collections issue through the lockdown. So this is a sector under incredible duress. We've got a fabulous panel for you today, led by Isana Cordier. Now, Isana is the head of consumer goods at Absa Corporate and Investment Bank. We've got portfolio manager at 361 Asset Management, Evan Walker. He is an expert in the retail sector, joining us. We've also today got Anthony Thunstrom, who's the chief executive of the Foschini Group. We've got the finance director of Foschini Group and also the head of marketing from SAB with us today. Isana, let's start with you. Isana Cordier from Absa CIB. There we are. And Bongiwe Ntuli is there, the Chief Financial Officer at the Foschini Group. And Evan Walker, I'm sure, will join us once he manages to get his wires connected. Isana Cordier, let's start with you, the Head of Consumer Goods and Services at Absa, Corporate and Investment Bank. A broad overview, if you would, of this sector in probably the most trying time, certainly beyond our lifetimes, in a century.
Bruce, it is interesting times indeed. So other than saying to you that right now the world is looking a little bit upside down for most of the consumers, what we're trying to do is look at data on a day-to-day basis and try and understand what's really happening out there. People have obviously been in lockdown. They've been constrained from spending behaviors, so they couldn't spend on what they normally spend on. Yet the data is telling us from a card acquiring perspective, people are still spending. They're just spending differently. And that begs to the question is, what is and how is this what the economy is?
Oh, Isana, your signal, unfortunately, is letting us down a little bit. Why don't we go to Anthony Thunstrom, the Chief Executive of the Foschini Group, while Isana sorts out her connectivity issues today.
And we trying to understand right now.
She's talking over us. Isana, we're struggling with your... I tell you what, we'll give you a chance to reboot, rejig, and recalibrate. Anthony, to you this afternoon, Isana talks about the fact that we all stayed away from the shops, and part of it was enforced. One gets a sense that people are being trickled back in again, albeit quite slowly, once you get through all of the hand-wringing and face covers and everything else.
Absolutely, Bruce. And I think what's fascinating is also how it's affecting different regions of the country, different types of shopping malls very differently. If you look at your major super regional malls across the country, particularly those that might have had an exposure to tourism, the V&A in Cape Town, Sandton City, etc., footfall's still well down, obviously a lot better than during the full lockdown, but well down in normal levels. And you'd actually be forgiven if you went to some of the more convenience rural shopping malls. You'd almost think there was no coronavirus that had never hit. You know, in some cases, some of those malls' footfalls are actually up on pre-coronavirus levels. So quite a disparity between them. People are trickling back. We saw a quantum shift towards online during the lockdown. I think there were, a lot of people that would back off immediately as stores opened. People could go and shop physically. It really shows no sign of abating at all.
Bongiwe, how's this translating then to the bottom line? We look at retail results across the board, and there's a huge amount of pressure, not only here, but in economies across the globe. And you've had that experience as well.
Oh yeah, no, thanks, Bruce. It's been quite tough. We lost obviously a whole month of sales in April, and not only in South Africa for TFG, but also Australia and the UK, who obviously were also in lockdown. So bottom line under pressure. Margins under pressure, but South Africa is a very resilient economy, and we've seen some uptick in the past few months. But certainly, April was has had a significant impact on our performance. So yeah, first half definitely under pressure for 2020.
So you don't for a moment believe today's jobs numbers, for example?
I beg your pardon?
You wouldn't be a believer in today's jobs numbers, not for a moment, at 23.2% unemployment in the second quarter. It's clearly a data issue. I mean, it's not reflecting the reality.
Yeah, no, far from reality for sure. Far from reality. Yeah, and I think the impact of COVID is still to be felt, a full impact of COVID and the impact on employment. I mean, it's a matter of time. Yeah.
Vaughan, Marketing Director at SAB. I mean, there was a moment where I was wondering whether or not my tap water was going to start tasting of Castle Lager. If you're going to pour it all down the drains and feed it into the water system, I was living in hope that you would have to do that and have to destroy millions of litres of beer, but you didn't. Give me a perspective, please, as one of South Africa's most consumed products, just how you guys coped.
Of course, our product is built on the premise of sociability. So it was incredibly challenging, particularly for our on-premise retailers and traders, the restaurants, the hospitality industry, the sporting industry. So an immensely challenging time for our business. But beer always proves to be quite resilient. So as we've resumed trading, we've seen really good volumes. I think to Isana's point earlier, definitely some shifts in behavior. I think the increase of the at-home occasion is a critical one for us to consider in how that plays out, and also people making decisions based on value. And we are positioned in the value segment of the market. We have a broad portfolio, but essentially we're in the value segment, which seems to be quite robust.
I mean, are we going to see the consumption of beer change fundamentally? All going on a trip in Europe and visiting Kompania Pirobushka and many other of the old SAB Miller sites, and going to Pilsner Urquell and many others, and getting a very clear sense that in Eastern Europe there was a very clear in-home market, and that was beer sold in 2-litre PETs versus the on-premise consumption, where people would hold the bottles like you guys always do, with the labels facing out, showing everybody what it is that you're drinking, where you go and show off what your favorite brew is. Are we going to see a fundamental shift towards more of that kind of consumption?
I do think in the short term, due to the financial pressures and the fear of going out and socializing, that you would definitely see people looking for really good value, and there being less opportunities to badge, like you said, with those labels. But will we see fundamental shifts in behavior? I don't believe so. We've seen the benefit of being part of a global organization is that we can learn from other markets who are slightly ahead of us in their battle against the pandemic, and I don't believe there will be fundamental shifts in categories. You would, however, see shifts to value. There's definitely a value-seeking behavior.
And talk to me then about restrictions on the sale of alcohol and the transportation of alcohol. At one point, where Becky Tele is stopping motorists on the side of the road and ripping cases of beer out of car boots and stuff, and your trucks would have been restricted in terms of their ability to deliver. Now we can do purchases in bottle stores Monday to Friday, not allowed over the weekends, but on-premise consumption is allowed. Just give me a sense of how the market dynamics are affecting you right now.
Yes, I think that fundamentally there's going to be an increased responsibility between the private sector and the public sector. That is something that we really strive for and aim for, to work with government. And I also find that there's a heightened need for true corporate sociability, not just with our corporate brand, but also with our consumer brands, so that they can play a meaningful an impactful role in society. And I think those were two of my bigger insights.
Take me through, Anthony, if you would, the shift online. So much of what we've seen happening in the world. Before we get to you, Anthony, and while I've got Isana, because Isana keeps pushing the off button on her computer. Isana, talk to me, please, about data, because you were making a very important point earlier about data and how data analytics is increasingly important in this world. And then I'll get to you, Anthony.
Thanks, Bruce. I'm sorry. I don't know. We're relying on technology a lot these days, and then it fails us on the most crucial points.
It
So
happened.
what I was trying to say, is that we are starting to rely a lot more on the data because of the uncertainty we find ourselves in. Consumer been restricted by laws, not in them to shop as they usually shop, been exposed to trends. They've exposed to going to malls less, and definitely we see basket sizes, but less to the mall. People are not going as much as they used to. And when we data year on year, it still looks like people got money. Remember that people didn't spend on travel as they used to. They didn't go out entertaining themselves. So it begs to question: does people just still have a little cash in their pockets, and how long runs out? We see the true reality of what's happening in this sector.
Okay, Isana, still struggling with that connectivity, I'm afraid. So let's move on to you, Anthony Thutram, and just try and understand whether or not the trends that Isana, who is now about to pull her hair out, don't do that, you've had it done specially, when we look at the trends that we certainly see in the grocery market, and talking to the CEOs of ShopRite and the Pick and Pay and the Woolworths, the basket sizes increased, the visits decreased, and people were very selective in the way they went and bought their groceries. Did that play out also in the world of clothing retail?
Yeah, very much, Bruce. I think, the reality is that e-commerce train had actually left the station quite a long time before COVID hit us. I just think most people in South Africa haven't really seen it. The percentages were relatively small as a total contribution. But again, picking on Vaughn's point, when you're exposed to global trends as we are through our offshore businesses in Australia and the UK, you could kind of see which way it was going in any event. When COVID hit, you'll remember the first month we couldn't even fulfill from an e-commerce perspective. It was amazing. People were still ordering and quite happy to wait for who knows how long, 4, 6, 8 weeks at the time. Nobody knew when you could actually start shipping. We went from, to kind of give a sense of scale in South Africa, at the beginning of our last financial year, e-commerce was 1% of our turnover. By the end of the year, it had grown 100%, so we got to 2%. We're currently running between 5 and 6%, and our Australian business pretty much doubled over the lockdown period as well. We saw actually both basket sizes increase, but also the number of visits increased dramatically, and I guess that's a reflection of people sitting at home, generally not going out as much as they used to, and spending more time, I guess, shopping online. So a fundamental shift was happening anyway. It's been accelerated, based on our own internal timeframes by at least 3 years. And I think, online shopping is a learned thing. Once you've realized you can use your credit card details, it's generally pretty safe. You generally get your goods within a day or two. You can return them if you don't like what you get. It's very hard to unlearn that. So I think it's just moved us forward a number of years.
I mean, you say you're forward 3 years. Satya Nadella, the chief executive of Microsoft, was saying that they saw 2 years of digital innovation in 2 months. And I think that's been the global phenomenon, that global learning that we have seen play out as well. When it comes to e-commerce and as a percentage of sales, it goes from 1% to 2%. You go, well, that's not very much. But that's a 100% increase, Bookie. I mean, suddenly you've got to cope with this huge new demand. It may not seem very much from the outside, but paint a picture for me, please, as to what it takes to scale up that quickly from an internal perspective.
Oh yeah, Bruce, very true. I mean, as a percent of sales, as you say, it looks small, but we've actually now are running at close to 5-7% online sales and growing. Internally, obviously, TFG was very well placed to take advantage of this growth, because I think for the past 3-4 years, we've invested significantly on our online platforms, My TFG World, and apps and internet shopping for all our brands. So actually, in our logistics as well, over the years, we had perfected them. So it was a very welcome opportunity to have this sale increase so significantly. And what it's done, actually, for a year or two, we ran online at a loss. And we just needed the volume, and this volume has obviously helped my bottom line, and certainly we're definitely breaking even for most brands, and even more profitable for some brands for sure. So it's been quite a welcome, and TFG
do you see
geared for it.
As a seminal moment, as a moment that we don't go back from? That, as Anthony was just saying a moment ago, people get a taste. It's a bit like that first sip of Castle Lager. Once you've had the first sip, you've got to finish the rest. Online shopping, I think, is probably...
Oh, for sure. And obviously, remember, we see it with actually the brands that support the younger generations. Online sales have just shot up 200-300% for those brands, and I don't see it going back in any way. Actually, see it escalating, continually, and as we continue investing, definitely on online for sure.
Evan Walker, there you are. As we came to you, you were glugging from a bottle, and I was hoping that it would be a beer bottle, but it's not. From your perspective, what has happened in the consumer goods sector across the retail sector in South Africa, and how have we held up worldwide over the last 6 to 8 months or so in this really weird time that we're all living through?
Bruce, it's been a number of different issues here. I mean, obviously we know anecdotally and also know through the reported numbers that the food retailers have done exceptionally well. I mean, everyone's rushing to Woolies Food and even ShopRite Food, etc., to procure what they would have been elsewhere eating out. And so there has been a change in consumption patterns. I think those will begin to normalize. I mean, in the Western Cape, we're seeing it normalizing quite fast. So I think countrywide it will begin to normalize. But certainly we've seen, a big move to additional home consumption, which has obviously propelled these food retailers into good levels of growth.
And the fundamental shifts that we're seeing, you've part of the discussion, but just this huge time, how big a change is this in South Africa's retail landscape?
Bruce, I think it's a very big change. I mean, it's a change for every single participant in these categories. I mean, obviously for all the retailers, it's a big change. I mean, it's a big change of thinking from a consumer point of view, but certainly from a retail perspective, I mean, it requires a lot from the retailer, and the consumer's changing dramatically, I mean, globally. I mean, currently there's two schools of thought. I mean, the one school of thought says that with with interest rates so low, we're going to start seeing inflation climb, and this is going to be good for retailers generally across the globe. And the other school of thought says, well, we're going more and more online. People are going to be pricing way more aggressively, and this is going to be very deflationary and cause quite a big hiccup to consumer growth or to retailer gross margins going forward. So there's two big schools of thought out there. I mean, we sit with the latter one. I mean, we think this whole online process, people going more and more online, is going to drive prices down. We think it's going to be a deflationary for retailers generally over the next 3 to 5 years. And obviously what we've seen in COVID now, being reported from most of the wholesale industries around the world, funny enough, is an acceleration to where they thought they would be from an online perspective 2, 3, 4. In some cases, some companies say they thought they'd only be in this position 5 years from now. So it's a dramatic shift, Bruce.
I see, Bongiwe, you're nodding. Is this the sort of stuff that makes your blood run cold? Does this scare you, a deflationary environment in retail? It's really quite scary to navigate.
Look, it is, Bruce, but again, we've seen the macros over the years, and TFG continually has produced deflationary sales year on year, and we continue on that drive. As we saw, the consumer was under pressure, price points, and had to come down, and through a lot of initiatives internally through our local manufacturing base, sourcing locally, working with local suppliers to deliver a product in store on time, quick response. A large proportion of our merchandise is on a quick response basis. So that has allowed us to maintain gross margins. If you see our gross margins over the past 2-3 years, they've just remained quite stable. In some brands, actually even growing because of all the initiatives we've done internally on the supply chain side, especially. Yeah.
And see, I mean, everyone seems to suggest be shutting down shops. You're going to be certainly reducing your floor space. You're going to be going for smaller formats. You're going to be fundamentally altering the way in which you look and feel into the future.
But just going back to Evan's point on the two schools of thought, again, just to share some of our thinking around that, I think in terms of the pure play guys and the pure online players, I think the latter theory holds water. It is a bit of a race to the bottom. Everyone's competing with the same stuff. To the extent that you've got strong brands, though, if you kind of think of global brands like Nike, Adidas, their margins when they shift online, if anything, get stronger, they don't get weaker. That's what Bongiwe is referring to in our own experience in South Africa. We don't sell off price, we sell pretty much full price. So I think you've got two different models. It depends where you play there. And then, going to retail space, again, I think we've got a slightly different view. It's not actually about e-commerce per se. It's really about an omni-channel experience. It's that blend of e-commerce and stores. The stores end up being your showrooms. They end up, certainly in South Africa, being where it's easiest to return your product if you're not happy with it. We've got the best part of 3,000 delivery or collection points situated around the country. Somebody said the other day we've got more branches than the post office, and that's, I guess, partly true. What we're seeing more and more is people actually fulfilling their online orders from our stores. We've got over 500 of our South African stores already connected to a central online database where you don't actually have to ship from a DC. It actually just comes out of store stock, and people can either go into the store and collect in the store, or it can be routed via algorithms from the store that's closest to the consumer. So I think it's going to be a blend of the two, and certainly again from a TFG perspective, we've got lots of brands that we haven't even fully rolled out yet. So I think if anything, providing we get the right rentals, we'll probably continue to expand, albeit cautiously.
And let's go to you, Evan Walker. I mean, this idea that we're going to see an expansion in retail is almost counterintuitive. But I suppose with Edcon downsizing very dramatically, and Edcon's sale of Edgar's and the sale of Jet, the dynamics in this industry are going to change quite fundamentally.
Bruce, yeah, I mean, we've been negative the sector for well over 5-6 years now, on the premise that there's just been too much space rollout and not enough consolidation. So for the first time, and thanks to the guys at Foschini, I mean, I think this is a great acquisition for them. I think it does consolidate the sector. I think it starts to do what should have been done a number of years ago in terms of the number of players in the sector overall, and the consolidation of the number of formats. So I think for the first time now, from an industry perspective, we're seeing the retailers going the right way. I think more so on the apparel side than on the food side. I'm still nervous about the amount of space that's been rolled out on the food side, but even there, we're starting to see, the guys battling. I mean, we know that the likes of Game and certain those formats are just not successful. I mean, the macros of the world are coming under pressure. So even there, I think over time now, and a lot of the cash and carry space is going to consolidate quite dramatically over the next 3 to 5 years as the retailers play harder in that space. So I think from an industry perspective now, we're seeing the right things. I mean, this is what we should be seeing from an industry. We go through these long, dramatic cycles. These cycles are very pronounced. They're good for a number of years. I mean, we've covered the space for 25 and we saw 15 very good years. But like any industry, people get overexcited and overinvest, and now we need that consolidation, which is happening. So this is the start of a good process, I mean, for the retailers, and we need to see more of it. So unfortunately, we need to see more consolidation in this space, and we need to see, unfortunately, the weaker players exit, and that's still going to happen.
But it does create an opportunity, doesn't it, Anthony? I mean, one talks to the likes of GT Pereira and Laurie Dippenaar and Paul Harris about, what the most difficult time in their 40 years in business was. Surely 1987 must have been the hardest time in South African history, as South Africa went into a debt default and was 2 years after the Rubicon speech, and South Africa was effectively in a civil war, and there were bombs going off, and we were fighting a war in Angola that we should never have got involved in and couldn't afford, and it was an absolute shambles. And their eyes light up. They said that was the best time when Barclays had gone, and there was the opportunity to consolidate in financial services, and it gave them a full suite. You're sitting in a position now where Edcon has failed, but you've sat on the sidelines and gone, thank you very much. We'll take nearly 400 Jet stores.
Yeah, Bruce, you couldn't have summed it up better. I mean, you go back, we actually looked at Jet in a lot of detail together with actually Edgar's and the whole of Edcon about 5 years ago. I just joined the group. We were approached by the shareholders at that stage proactively to possibly do a deal. And frankly, there were a number of issues with the business, the least of which was not the purchase price. To have bought Jet 5 years ago, you would have shelled out somewhere between 7 and 8 billion rand. We'd managed to do a deal at well below R500 million for pretty much the same business. That opportunity can only come at a time like this. I think if you go back, as a group, we also embarked on a capital raise. We announced that at our results presentation. Part of it was to make sure that we could, withstand the choppy waters ahead. No one's got a crystal ball. But the other big part of it was the consolidation that Evan spoke about. We didn't see, we can't predict what will fall over when, but it's going to happen in retail right around the world. There are going to be fewer players in 12 months' time than there are now. And we just wanted to get in a position where actually you can act on good opportunities if you find them. So, yes, I think a unique opportunity. Tough at the time, but once in a lifetime.
Isana, I mean, what is your sort of crystal ball view of this consumer goods sector? I mean, the opportunities present themselves. One would regularly talk to Brian Joffe when he was at Bidvest, and the moment somebody was coughing, Brian Joffe would be around knocking on the door saying, "Hello, you feeling all right? Should we talk business?" Do you see more consolidation coming in the South African consumer goods sector?
I would think there should be more consolidation. I think the consumers in South Africa is just exposed to a lot of choice at the moment. And it makes, I know it sounds funny, but consumers actually want less choice. A lot of what's driving their behavior, I think, is becoming more about simplification, simplifying their lifestyles. If new trends emerge, work from home, what are they going to wear? Are they going to shop where they used to shop? How are they going to eat, where they're going to spend their money? So I definitely think more consolidation is very likely. I'm not sure about how that consolidation would, because traditionally we have been dominated by big retailers. I see a lot of small retailers launch line, and over time they will start eating into the pockets of the bigger retailers, especially in certain categories like clothing. Other categories like food, I think you're going to be, it's just different. People need to eat. Doesn't matter when it's almost the same as alcohol. People drink, whether it goes good or bad, people drink, unless the government stops them from drinking, of course. So, yeah, I don't know. I think more consolidation, I think changing behaviors. How is retailers going to adapt their models to quickly respond to the consumer's needs? And be more nimble and quick. And I agree with Anthony in that it's probably an omni-channel strategy, but also just more flexible. And I think there's opportunity in bringing more from the value chain closer to home. The value chain means more manufacturing here in South Africa. That's an opportunity we need to look into and capitalize on for our own economy.
There's such an interesting thought there. I mean, Anthony, is that the plan? Because we saw Grant Patterson got rid of a lot of the big brands, for example, within Edgar's, and did a lot of manufacturing at home, and that was devastating for those manufacturers on the lockdown, as he told them he couldn't pay his bills anymore. But the opportunity exists. Global supply chains have been so massively disrupted. Suddenly, this idea of deglobalization begins to take hold. Do you see that happening?
Yeah, Bruce, funny enough, we'd already been heading down that route for the last 5 years in South Africa, and the reason for that was largely pure economics. Your lead times if you manufacturing through, as long as you've got really world-class facilities, the right technology, the right data coming out of your sales system, what you should be manufacturing to restock. We were looking at 42-day lead times in South Africa versus 150 to 170, 180 days out of the Far East. Your net result is you're taking far less fashion risk if you manufacture locally. You can make your decisions based on real-time data, and we were getting a better gross margin as a result. With COVID, it's become absolutely critically important. I don't think there's a single retailer in the world who can forecast December or January sales with any degree of accuracy now. We just really don't know where the consumer is going to be. We don't know if the virus comes back again, the second, third wave. There are just too many variables out there. If you don't localize, if you don't have a vertical supply chain, the reality is you're having to take big bets half a year out. And that wasn't sensible before COVID. It's certainly, it's not sensible now. So, we'd upped our local manufacturing by 30-40% over the last year. Pre-COVID, we were going to double our local manufacturing over the next 5 years. That probably accelerates to 2 or 3 years. Absolutely, I think we're to that.
That's huge. And also it's changed. Robbie Brosen calls pajama bottoms schluffing pants. You have no idea whether I'm even wearing trousers at the moment, courtesy of the wonders of the Zoom experience. Isana's eyes just got bigger. But the fact hasn't changed. We haven't needed to upgrade wardrobes. We haven't needed to go and shop in the same way as we shopped previously. People like Evan Walker are wearing T-shirts in meetings, for goodness sake. This is an asset manager. The world has changed fundamentally.
I dressed up, Bruce. I dressed up.
I know, and we're grateful for that. The fact that you even did get dressed is amazing. But this challenge of this world that, I'm sure some point in 2021 we go out and buy a new suit and get seen in public again. But how has that shifted and that changed?
Fundamentally, Bruce, I think in the short term, you're 100% right. There's been a massive shift towards casual, towards anything to do with work from home, be it furniture, decorating your house, home technology, and a massive shift, I think, towards, it was already evident before COVID, but an accelerated shift towards anything with health and wellness, running gear, yoga mats, gym equipment, weights, etc. As a matter of fact, weights sold out in South Africa. You couldn't buy a set of dumbbells for little money over the last couple of months. So I think certainly for as long as, it's probably not forever. The world probably went through a similar process of not wearing suits and dressing up over, 2 world wars. Eventually you get back to some form of normality, but that sense of normality could be, 12, 24 months from now. So yeah, much more casual. And the other point that was mentioned earlier on by Vaughan was around value. I think as economies, and particularly in South Africa, as the economic reality bites, there's definitely a shift towards value for money. That doesn't mean cheap, it just means value for money right across all the LSMs, and I think that's becoming more evident as each month goes on.
Well, Crozier, when we talk about supply chains and we talk about beer, beer is, by certainly old SAB standards, very much a local product. People have a huge affinity for their local beer brands, and there have been a couple of really successful global brands. Budweiser, which comes out of your parent AB InBev, Stable has been very good. Stella Artois is one. There's the Heineken and the Carlsbergs of the world that have transcended the borders. But when you look across the African continent, where you have a very substantial footprint, where you are one of the biggest brewers on this continent, beer is local. How does the beer market change in this environment?
Bruce, we've been using local materials in our beer for more than 5 decades. We have a thriving hop industry and barley industry, glass manufacturing. In fact, for our local brands, more than 95% of our ingredients are procured locally. So that is really exciting. We also have opportunities to brew some of these imported brands here because we have the right technology and breweries to do that. And then further along our value chain, we also procure our merchandise and point of sale materials. More and more that is being procured locally, just as part of this commitment that we have to growing South Africa. I think during the alcohol ban, I think it was quite stark to see how deep that supply chain is into South Africa, and we're very proud of that supply chain, and hopefully we can continue to maintain it far into the future.
Yeah, and it's absolutely critical that you do. I mean, because the global sense of the globe has also changed very, very strongly as well. Isana, in terms of payment, and has there been a big shift in payment systems? There's some places where, you take out a banknote and people recoil as if you've just coughed in their direction. There's a reluctance to deal with cash. Cash is seen as this magnificent transmission mechanism for coronavirus. Have you seen a shift in payment mechanisms? Is there more of a digital change?
I think definitely we've seen reduction in cash, but it could also be because of the items that was predominantly used to buy cash with, like alcohol and cigarettes, were also restricted. So over this time, the cash in the cycle reduced significantly, but because of the trading conditions predominantly, I don't think cash is going to go away. I don't think for the lower LSM market, it's still the predominant payment mechanism. However, the banks are obviously all part of work streams where we try and see how we displace cash somewhat and bring in different payment mechanism other than card also that could work and make people the currency available for people to trade in, because cash is just dangerous in so many ways. And if the virus is one of them, we got to face that.
Yeah, at least the virus doesn't take your money away. Well, not yet anyway. It hasn't morphed to that extent. Evan, we've seen the shift to digital in so many interesting ways. And South Africa has been very, very slow in terms of its adoption of online shopping. And earlier, Anthony and Bongiwe were just telling us about the massive escalations they've seen from a very low base in terms of the evolution of online purchasing and online transacting. I suppose the company that stole the show over the last 6 months has been ShopRite. Their 60 offering, while minuscule in their world, is evidence as to what can happen when you get it right, and how that when you serve your customers in a way that is intuitive and simple and easy, that they will come along for the ride.
Yep, there's no doubt. I mean, they have stolen the show there a little bit. I mean, it's not available in all areas yet, Bruce, but I mean, certainly for the guys that can use it, I mean, it's been a successful product. I mean, I've got to hand it to them, and they seem to have got their logistics right, which we've spoken about earlier is obviously the tough part, especially in food. I mean, we can have limited assortments, and people are obviously chopping and changing, and you've got to have the all the fresh produce on the shelf. So that, I mean, they have seemed to have got this right. It was quite a it was quite a robust sort of performance from them, and especially to go out with this sort of 60-minute offering. I mean, I'm sure it was quite challenging for them to get it right, but they certainly seem to have got it right. I mean, the feedback has been very positive. I mean, from everyone that's used it. I mean, I've used it, but it seems to have been very, very positive. So, I've got to hand it to them. They seem to have jumped ahead of their competitors in this space. And we'll see if they can maintain that. I certainly think they put the impetus in place to do such a thing.
What about the challenge for Anthony and Bongiwe? How do they manage this better into the future? Because the world is certainly moving that way.
Challenges for them are going to be store-related challenges, not so much online challenges. I mean, obviously they can sort out the logistics around, their reverse logistics, people wrong sizing, etc. I mean, I think they can get that right. And as Anthony rightly said, I mean, he's got a couple of stores out there, a couple of thousand stores in which he's effectively got a warehouse. So, I think the challenge for Anthony and for the Foschini Group and apparel retailers going forward in what's going to be quite a different landscape is actually getting people back into the stores, because without getting people back into the stores, you don't want to have 3,000 stores, sitting idle all day. So, I think they're going to have to be innovative. I think they're going to have to offer reward mechanisms to get people back into stores. I think it's going to have to be an experience. Service levels are going to have to improve in store. So I certainly think there's going to be a number of issues that they're going to have to look at very carefully to ensure that their store bases over time are just not redundant. I mean, and that's probably going to be a difficult exercise for a lot of retailers around the world, is to ensure that their stores are no longer redundant to the consumer.
It's such an important point, Anthony and Bongi. I don't know who wants to pick up on that, but the service issue is one that South Africans, I think, are born clearly, because, and I increasingly have this issue as we tear our hair out when you go into a retail environment, and you met with either a blank stare or somebody who's not been adequately trained, or somebody who doesn't really have a clue on what your needs are. If you're going to turn the store into the experience and into literally the shop front where I can go and experience what you have to offer, so that when I go home, I know that my size is my size and I can go across multiple brands and get an appropriate size, how are you going to evolve? It's a great opportunity and a hell of a mountain to climb.
I'll jump in on that as well. Look, we hit the nail on the head. It's particularly in South Africa, it's tough. I mean, the turnover within the retail sector, store staff, is incredibly high in South Africa. You're looking at well in excess of 25% a year. So there is a challenge around getting people to know the product, know the sizing, be really committed. I think one of the things we've picked up again over the last 18 months, we've been rolling out a lot of digital training. All of our staff can actually access the full suite of training specific to the brand that they work in. It can be done on their smartphone. They don't even need to use their own data. We've got reverse billing arrangements with the major networks. So they can either train in downtime, over a lunch break, they can train at home. We've certainly seen a noticeable improvement in terms of their performance and customer satisfaction, but it still is a big challenge going forward. One of the things, again, we picked up from our offshore operations, which we're trying at the moment, is really bringing in effective incentive schemes that reward store staff for doing the right things. And it seems like a very obvious kind of model. Very few people have managed to get it right, particularly in South Africa. It's got to be very, very nuanced and targeted. We're in fairly advanced stages of testing a couple of mechanisms at the moment. And I think that over time, that will certainly help. I think just going back to Evan's point, though, around the challenge on stores, I think he's 100% right. If you try and balance the stores and the online, it is kind of a touch and accelerator type model. You've got to get that balance right. We do holistically believe that there's room for both, but it's getting the kind of pace of change or the shift manageable. We're lucky in South Africa, most of our leases are pretty short. Our average lease term to term is about 2.5 years. Matter of fact, slightly less now. 2.3, 2.4 years, so we've got a lot of flexibility around it, but it is critical to get the balance right. And the key, I think, in terms of the shopping malls, is you've actually got to build your brand. You've got to have the strongest brands when you go into a shopping mall in whatever category you're selling. Whether it's jewelry, homewares, men's apparel, sports gear, whatever it is. Particularly at the moment, you don't want to be brand number 2, 3, or 4. You want to be brand number 1 or 2 in the customer's eyes. If you can get that piece right, and that unfortunately takes years of investment, but if you get that piece right, the chances are you'll end up being winning.
We'll give it consumer health, and you see it, I think, on a daily basis in terms of the way spending is happening, the mechanisms people are using, whether they're extending credit, whether they're struggling to pay their answers. Paint a picture for me, please, Bongiwe, on consumer health, if you would.
Certainly. I mean, again, COVID is showing a lot of things that were already in the system. As I said, the macros were already under pressure globally as well. So over the years, TFG, we've just reduced our credit offering to customers. Our acceptance rates used to run at about 56%, say 3 years ago. Over the past few years, we've dropped them down year on year. Last year, acceptance rates were 36%. This year, we've brought them right down to even single digits, because, again, the consumer was under pressure. And also, Bruce, I must also add the cash growth in our stores has continually increased. So we have not really been under pressure to offer credit to boost our sales. But having said that, it has an impact on sales, and we have cut it down significantly. And then collections as well. There's active mechanisms that we've done to entice the customers to pay. Just to also paint the picture for you, pre-COVID, 90% of our store customers paid in stores, so physically paid in stores. And we encourage that because obviously it provides an opportunity to on-sell to the customer. And when COVID hit, we had to actively look at digital platforms, working with the likes of the Absas to encourage, and a lot of other service providers, to encourage the customers to pay digitally, using digital means, and also work with food retailers that were open through various partnership with things that we adopted. So we sit today with provisions as well. Also, IFRS 9 came into effect, which again placed a lot of emphasis on providing for debt upfront. So it requires you that when you sign up credit, immediately you then raise a provision based on the health of what you think the health of that customer is in terms of repaying the debt, the risk is. So all of those factors made us over the years start reducing our reliance on credit sales and encourage and reward cash payments and obviously lay-bys and customers to actively pay their accounts and keep them current. But definitely under pressure. You've seen the results from a lot of banks in the past few months, a lot of bad debts write-off, increase in provisions, and I think that's not going to change for a while in the reality of the times.
Brent has a question for you, Bongiwe, saying, do you foresee your business increasing investment in e-commerce platforms? I think that's inevitable, isn't it?
Inevitable. Like I said, we were spending, just to give you some color in terms of numbers, year on year, we've spent at least 1 billion, 1.2 billion in CapEx, even in a downward cycle, because we knew that a lot of that investment will come to bear and help us in future, as we knew that it's a matter of time. We see that in our international businesses that e-commerce had a critical role to play, and online was growing significantly overseas. So we've invested throughout the cycle. We'll continue to invest. A lot of our CapEx, 75% year on year, has been on an expansionary type of CapEx. E-com platforms, and I think we'll continue to enhance, and that's what has helped us, to be quite honest, in times like this, that we're able to switch on. We're ready to handle the demand on online platforms in times like this. So certainly we'll spend more, definitely.
Evan Walker, delivery was a nightmare at the beginning of lockdown. Suddenly there was this huge surge in demand, and everyone with a mobile and a skadonk of a car suddenly turned into delivery person, and you would see people going through the streets and going and dropping off boxes at people's houses. And it was a really great example, I guess, of how adaptable people are in a time of crisis. One wonders just how well we've actually coped. I mean, is there any data to back it up, Evan, or Isana, if you can contribute on that?
Yeah, Bruce, I don't want to use my own experiences on coping because they haven't been good ones. The big mammoth. Hey, you don't want to hear mine, Bruce, because the reverse logistics is all my experiences have been horrendous. So we don't even want to go down that road, and we're not even talking about the big mammoth, the big online delivery company in this country. Who really does struggle with the reverse logistics. Trying to send something back is virtually impossible. So. Yeah, I mean, Bruce, I think it is evolving. I mean, there's no doubt there was a flurry. Every Uber driver, every scooter was used in the mechanisms up front. I think guys will sort it out. I mean, I don't think that's the big issue here. I think we will get that sorted. For a lot of people in a lot of places, obviously, just drop-offs and times, and every time I schedule a time, I'm never there. I mean, when it arrives, I'm never at home, and no one's there to accept it. So it's a little frustrating. But I mean, if you are there all the time or all night, then it's probably a little easier. But yeah, I think it's going to work out over time. But there's a lot of nuances to this online that still needs to be sorted out, and it's just a mammoth discovery for most retailers.
I think I spotted the problem, Evan. I'm not sure if it's the retailers. Isana.
It could be my IT skills, Bruce.
You concur with Evan's analysis, in terms of the reverse logistics. And this idea of reverse logistics is really important because you're going to be reluctant to buy online if the return process is difficult? And there are countries which are far more evolved than we are in terms of delivery and the returns. What's the research telling you about South Africa, Isana?
Yeah, no, I agree. I think, but return logistics is one thing. I think first to get your customer to just trust the system enough so that they become a comeback customer every month. I think that's where data is going to play a big role. Bruce, because I bet you when you go to Woolworths every month or every week, in your case, maybe every day, you buy the same items over and over. Now imagine your retailer of choice starts getting your behavior correct, and they do because they have loyalty cards, right? So they can see this is Bruce, he buys bananas every Saturday together with his milks and his eggs and I don't know, whatever caviar or fancy stuff you like. Then you can start having a predictive model and say, this is your shopping cart. Do you want to change something? This is your normal delivery slot. Are you happy with this? Can we deliver for you? So I think that is the kind of things retailers, especially in the food and the more consumable places, need to start thinking about. How can they start adjusting their models to predictably serve their customers as well, and not just be a responsive retailer. In the clothing space, I think it's more about understanding who your client is, getting the sizing right, and exactly what you say. If it doesn't work, have your logistics set up so it's easy to turn. I've actually had opposite experiences than Evan. I find very good return experiences with big retailers. So I think, it's just about getting the logistics right. I think partnerships is going to be very important. And I think in South Africa, retailers tend not to want to partner with their own kind. But when it comes to sharing logistics and sharing that experience, there is a big benefit than learn from each other's mistakes, leverage each other's already systems that's in place. And you know what? I think as South Africans and corporates, the market is big enough, but they're going to have to start thinking about working together. Even things like warehousing, just make it easier for this as well.
Don't tell Ibrahim Patel. But Auntie, how much of that stuff is happening?
Oh, yeah, then.
No, Bruce, I've got a totally different view to Isana. We're very happy to learn from our competitors' mistakes. We do that all day, every day, and it puts a smile on my face. The reality, though, is you actually want to carve out a competitive advantage. And I think the good minister would agree with me on this. If you can carve out a competitive advantage, it actually forces other people to follow and become more efficient themselves. You go back to the warehousing piece again. We get into a stage where I can foresee in the next 12 months we probably won't have an online DC in the country. We'll probably fulfill entirely from our store network. And again, it's keeping on pushing with the technology. Just going to the data piece, one of the things that we've launched recently, we've moved actually, it's also fascinating how quickly some of the trends move. We've gone from running websites by various brands really to having apps for your smartphone. Internationally, 70-odd% of e-commerce, certainly clothing e-commerce, is now shopping apps. We launched a couple over the last few months. One of the functions in it across the apps is you can take a photograph of Bruce the way he's dressed at the moment on your screen. It'll catalogue that photograph against every single product we've got across all of our brands in South Africa. It'll come up with 5 or 6 different checked shirts, blue blazers, different price points, different brands, and make suggestions based on things both in the photo and that you bought in the past. So that personalisation is going to become absolutely fundamental, both in clothing as much as it might be in the food retail space as well.
If we've seen exponential growth, and I think we wrap up this afternoon, if we've seen exponential growth in online and we're seeing some very real shifts, partly driven by economics, partly driven by society, partly driven by the fact that we're becoming more digitally connected than ever before. If we've had this huge progress in a relatively short period of time and it's been forced upon us, are we going to see that exponential growth curve? Do we see it continue? I wonder. And I wonder what your business looks like 5 years from now. Maybe, Vaughan, I mean, you guys have been through hell and back. You've been boxing with both hands tied behind your back for much of the last 6 months. Are there going to be fundamental shifts in things that have happened to you over the last 6 months that are going to determine across this African continent in particular, the way in which your business is going to evolve? Let's put it a 5-year time frame. How is it going to change? That's you, Vaughan.
I'm assuming that question was directed at me, Bruce. I think one of our learnings around e-commerce is that the only about 4 or 5% of South Africans have bought alcohol online, so it is a significantly small portion. However, where we have seen a great acceleration is on the business-to-business side. So creating technologies that help our retailers optimize their revenue through algorithmic selling and using AI to determine what the right order quantities and basket sizes should be for these retailers. And I think that's an area where I think we can extract massive value, but also create some value for our retailers. So that's been a big shift for us.
And Boogie, from your perspective, and I'd be interested to see whether or not you're on the same page as this, and I'm hoping actually just won't just be polite, say, yes, she's absolutely right. The evolution of the group business over the next 5 years?
Look, Bruce, I think it's going to be challenging. I think we're on the right track, we're on the right journey. Obviously, the acquisition of Jacked and a large proportion of our local manufacturing places us in a very good stead to be able to competitively gain market shares continually in the next 5 years. We've geared up balance sheet, we've strengthened our balance sheet and shored it up, and there's opportunities. So, while it's probably challenging, I think there's a lot of opportunities. And I think that we are very well poised with a strong balance sheet, strong free cash flow, and obviously large proportion of our local manufacturing for our apparel. I mean, I think we said earlier on, we manufacture at least 20-25% of our apparel locally. We see that expanding significantly. And consumer behavior, we watch it. I think less and less credit and more cash sales. And I think also authenticity. Customers are going to look for support businesses that are authentic, that think about the consumer and so on. And I think TFG is quite well poised for that. To take advantage of any opportunities there.
That's the finance director's response. From a look and feel perspective, how do we change over the next 5 years?
I've learned in life, one is the CEO should never disagree with the CFO, and the CFO's job is to make sure the CEO has money. So as long as you get those two right, you're off to the races. I think what Bongiwe didn't answer was where do we see online going and that landscape. And again, I'll probably be more than, maybe I'll be proved wrong, but I doubt it. We'd originally, going back a year or so ago, we thought we'd be 5% of online turnover, or 5% of our turnover in South Africa would be online by 25. Conservatively, that's going to be north of 10%. It wouldn't surprise me if it's north of 15%. So I think it moves that quickly for all the reasons we've already discussed on the show. Once you're there and once you're used to it, once you've got trust in the system, I think it really does ramp up exponentially. You might have a bit of a softening over the next month or so as people start to wander back into shopping malls. But again, it's behavioural. It's just too convenient. The systems are getting too good. It's why wouldn't you?
Very good. Evan Walker, your crystal ball. Do you ever get back into being interested in investing in this sector, I wonder?
Yeah, Bruce, as I said to you, from an actual industry perspective, I think the sector is looking very interesting. Unfortunately, the biggest single headwind we've got in South Africa at the moment is just the expense of our public sector wage bill, which unfortunately doesn't come down dramatically in the next 3 years, where we're looking at a currency north of 30 to the dollar and a bond rate of 20. So, we've got this big single headwind in South Africa now, and that's called the public sector wage bill, which is unsustainable. and it needs to be curtailed over the next 5 years. Otherwise, we haven't got a domestic economy. It's as simple as that. It's just got way out of proportion. But from an actual industry perspective, as I said to you, what's happening on the floor now, and the likes of Foschini and these retailers really have the upper hand. They need to create more and more flexibility in their businesses. We've seen the likes of Anthony and Foschini obviously reduce their lease times. I wouldn't like to be a landlord in the South African market for the next 5 years. I think these retailers are going to be brutal, and I think they should be. They had 20 years of uninterrupted growth, and to the extent that we see some of these prices they charge in some of these malls per square meter, I think are still horrendous. So, good luck to these guys, but I certainly hope they give the landlords a tough time. And I think it's all about flexibility in their businesses. They're doing exactly the right things. It's just unfortunately now that we need to return to growth, Bruce, and we know that. We talk about it on your show all the time, and we need jobs, and more jobs, and the ability to create those jobs is going to come about, if we see this initial pain from a reduction in our public sector wage bill and an ability for this country to transform itself back to spending on roads and infrastructure, etc., and the corruption that you talk about so often on your show. So, I think it's there, and I think the industry is moving in the right way. I mean, but it's probably going to take another 2-3 years of pain. But certainly, Bruce, we look out for consolidation in industries, because industries, we didn't invest in the platinum sector for 10 years until 2 years ago when we thought there'd been enough pain. And it's likewise in the retail space. We're looking, and we like pain, Bruce, because the more pain these retailers go through, the more their long-standing shareholders will capitulate. Okay, and we'll be there to buy their shares, and hopefully we'll buy them at the right time when this country can transform itself. And I still am of the optimistic view that we can transform this SA economy back to growth. So I'm definitely on the side and waiting. And actually, we did take a lot of Foschini shares in their placement a little while ago. So I think we've sold them all already at 90 Rand, and they're back at 80 today. But we'll certainly be back and buying them again because we like the story. Sorry, Anthony, we also have to make a profit.
Thank you very much indeed. That was a good preach. Thank you very much, Evan Walker. From you, Isana Cordier, wrap it up for us if you would, with your perspective, please, as to what the sector looks like 5 years from now. Is it a short-term horror show with a recovery coming into the future?
Bruce, I'm also like Evan, choosing to be optimistic. I do think the one thing we take out of COVID is that we got a huge shock to the system. And what happens when there's a shock to the system is hopefully people wake up and realize that we have been in a very bad space for quite a while, for reasons that I think Evan went into. We need more jobs in different industries, in industries where it's needed. We need to bring manufacturing back to South Africa. We need to look after our own economy and our consumers' health. We need to make sure we understand the health of the consumer and be socially responsible in how we serve our consumers. And as Absa, we are committed to our clients, and a big part of our clients is our retailers. And through this COVID period, we've supported them. We've seen them work very hard to understand how they're going to cope. And they've done that very well. And we are proud to say that we've partnered with them, and we will continue to partner with South African corporates and the retail sector, because we do believe in South Africa and the economy, and we think it will recover. But it is going to be tough. And I think next year is going to be particularly tough.
Thank you very much. Isana Cordier, the Head of Consumer Goods and Services at Absa Corporate and Investment Bank. To Vaughan Crozier, the Marketing Director at SAB. Thank you very much. To Evan Walker, Portfolio Manager at 361 Asset Management. To Bongiwe Ntuli, the Chief Financial Officer at the Foschini Group and Chief Executive. Anthony Thunstrom, thanks very much, you guys, for joining us today. To those of you who've joined us for this very special Insights series with Absa Corporate and Investment Bank, thank you very much for watching. And we look forward to seeing you again next time. Bye-bye.